Welcome. I'm glad you're here for this one. Over the next 20 minutes, we're going all the way back to ancient clay tablets and walking forward to the banking app on your phone. It's a story about trust and how far people have gone to protect it. Let's get into it. Picture a merchant in ancient Mesopotamia, 4,000 years ago. He doesn't have coins, he doesn't have a wallet. What he has is grain, stored in a temple, and a clay tablet that says how much of it belongs to him. That tablet is the first receipt in human history. It's also, in a very real sense, the first bank statement ever written. Banking didn't start with marble buildings and men in suits. It started with grain, temples, and trust. Let's trace how we got from clay tablets to credit cards, and why that story matters more than most people realize. The temples of Mesopotamia, around 2000 BCE, temples in Babylon served a function we'd recognize instantly today. Farmers would deposit their grain there for safekeeping, since temples were seen as sacred and therefore safe from theft. In return, priests issued records of what was stored. Over time, people realized something. They didn't need to withdraw the actual grain to make a payment. They could simply transfer the claim on that grain to someone else. That single idea, transferring a claim instead of moving the physical good, that is the seed of every banking system that followed. The Code of Hammurabi, written around 1750 BCE, even included rules about loans, interest rates, and what happened when a debt went unpaid. Interest wasn't invented by Wall Street. It was already being regulated by Babylonian law nearly 4,000 years ago. Coins change everything. The next major leap happened in Lydia, a kingdom in what's now Western Turkey, around 600 BCE. Lydians started minting coins from electrum, a natural mix of gold and silver. For the first time, value had a standard, portable, verifiable. You didn't need to trust the person you were trading with, you just needed to trust the stamp on the coin. Coins spread quickly through the ancient world. Greek city-states adopted them, and each one stamped its own coins with its own symbols, essentially branding their currency the way companies brand products today. The Roman Empire took this further, creating one of the first truly widespread monetary systems, with the denarius circulating from Britain to Egypt. But here's the thing coins couldn't solve. If you were a merchant traveling from Rome to Alexandria, you couldn't exactly carry a chest of coins with you. Robbers loved chests of coins, so merchants needed something lighter. They needed paper that represented value, backed by trust in an institution rather than trust in metal. The Italian bankers. Fast forward to medieval Italy, and we arrive at the moment banking as we know it really takes shape. The word bank itself comes from the Italian word banco, meaning bench, because moneylenders in cities like Florence and Venice would sit on benches in marketplaces to conduct their business. In the 1300s, Italian merchant families started doing something clever. If a merchant in Florence needed to pay someone in London, instead of shipping gold across dangerous roads and seas, he could deposit money with a banker in Florence who would issue a letter of credit. The merchant's contact in London could take that letter to a partner bank and receive the equivalent funds locally. No gold had to physically move at all. This system, called a bill of exchange, was revolutionary. It meant trust could travel faster than money. The Medici family in Florence built one of history's most powerful banking empires this way, financing everything from wars to art, including work by artists like Michelangelo. Banking wasn't just enabling trade anymore, it was funding culture itself. Venice went a step further. In 1587, the city established the Banco della Piazza di Rialto, one of the earliest public banks, designed specifically to bring order to a chaotic system of private moneylenders. Deposits, transfers, accounts, starting to resemble something a modern person would recognize. The birth of central banking. By the late 1600s, a new problem emerged. Countries were fighting expensive wars, and kings kept borrowing money they struggled to pay back. England found a solution in 1694 with the founding of the Bank of England. Here's how it worked. A group of investors lent the English government over £1 million to fund a war against France. In exchange, the investors were allowed to form a bank, print banknotes, and manage the government's debt. This was the first modern central bank, and it introduced an idea that still shapes the global economy today. A national institution that manages currency, controls the money supply, and lends to the government itself. Sweden's Riksbank actually predates the Bank of England by a few decades, founded in 1668, making it the oldest central bank still operating today. But the Bank of England became the model that other nations copied, because it solved a problem every growing economy eventually faces. Someone needs to stabilize the currency and prevent the entire financial system from collapsing every time confidence wavers. Paper money goes mainstream. For most of history, paper money was a promise. It represented gold or silver sitting in a vault somewhere, and you could, in theory, walk into a bank and exchange your paper note for the real metal. This system is called the gold standard. For centuries, it gave people confidence that currency actually meant something tangible. The United States wrestled with banking instability for much of its early history. Alexander Hamilton pushed for the first Bank of the United States in 1791, hoping to create financial stability for the young nation. It was controversial. Many Americans distrusted centralized financial power, fearing it echoed the aristocratic systems they'd just fought a revolution to escape. The bank's charter expired in 1811 and wasn't renewed. A pattern followed. The Second Bank of the United States rose in 1816 and was killed off by President Andrew Jackson in the 1830s, who saw central banking as a threat to ordinary citizens. For decades after that, America ran on a patchwork of state-chartered banks, each issuing its own currency with wildly inconsistent value and reliability. It was chaos. A dollar issued by a bank in Ohio might be worth far less than one issued in New York, and counterfeiting ran rampant. This chaos eventually led to catastrophe. Financial panics hit the US repeatedly throughout the 1800s, wiping out savings and triggering recessions. The Panic of 1907 was the final straw. Confidence in banks collapsed so badly that J.P. Morgan, a private banker, personally organized a bailout to stop the system from crumbling entirely. If a private citizen has to rescue the entire economy, that's a sign something structural needs to change. The Federal Reserve, building toward a turning point, that realization led directly to the creation of the Federal Reserve in 1913. The United States finally built a central bank designed to act as a lender of last resort, regulate the money supply, and prevent the kind of panics that had plagued the country for a century. The timing mattered enormously. Just over a decade later, the Great Depression tested the entire global financial system. Banks failed by the thousands in the early 1930s as panicked depositors rushed to withdraw their savings, only to discover the banks didn't have enough cash on hand because that money had been lent out or invested elsewhere. This is called a bank run, and it exposed a fundamental fragility in how banking worked. In response, the US created the Federal Deposit Insurance Corporation in 1933, guaranteeing that if a bank failed, ordinary depositors wouldn't lose their savings. This one change restored public confidence and remains a cornerstone of modern banking safety today. Leaving gold behind. For most of the 20th century, global currencies were still tied to gold in some form. That changed permanently in 1971, when President Nixon ended the direct convertibility of the US dollar into gold. This event is often called the Nixon shock. From that point forward, the value of money wasn't backed by a physical commodity at all. It was backed by trust in governments and central banks to manage it responsibly. This is called fiat currency, and it's the system nearly every country uses today. Your money has value because everyone agrees it has value, and because institutions work to keep that agreement stable. Banking in the digital age. The late 20th century brought ATMs, credit cards, and electronic transfers, each one removing a little more friction from moving money around. Then came the internet, and banking moved from buildings to browsers. Online banking, mobile apps, digital payment platforms. Something that once required a trip to a physical branch now happens from a phone in your pocket. The 2008 financial crisis reminded the world just how interconnected and fragile modern banking had become. Complex financial products, risky lending, and insufficient oversight led to a collapse that rippled across the entire global economy, costing millions of people their homes and jobs. It was a stark reminder that despite centuries of evolution, banking still carries the same fundamental risk it always has. Trust, once broken, is expensive to rebuild. In the years since, new forms of money and banking have emerged. Cryptocurrency and blockchain technology introduced the idea of transferring value without a central institution at all, echoing, in a strange way, the earliest debates about whether money needs an authority behind it, or just widespread agreement on its value. From clay tablets in Babylonian temples to apps on a smartphone, the story of banking is really the story of trust, and how humans have tried to formalize it, protect it, and sometimes exploit it. Every innovation, coins, letters of credit, central banks, deposit insurance, digital transfers, they all exist to answer the same basic question civilizations have asked for 4,000 years. How do we trust each other with something as important as value itself? That question isn't going away anytime soon. It's just finding new answers, generation after generation. So, that's the story, from clay to coins to a screen in your pocket. It's really never been about money at all. It's about trust, and how far we'll go to protect it. Thanks for listening. I'll see you in the next one.